It is very important to determine the direction of the cash flow and how they change. I mean, you have the sequence, especially the first one, if it's positive or is negative, and then what happens with the rest. And it indicates the function of the idea, the financial idea that we have. I mean, in a sense, it's either lending or borrowing. Okay, this was the very short recap of this pitfall number 1. Now we have the pitfall number 2. It's legendary, called multiple rates of return. Sometimes it's like multiple rate of return. Grammatically, some authors write this, some. Okay, now we have a beautiful example, and I would like you to draw a table. I know the table is on the next slide on PDF, but if you could use your imagination, it would be very nice. So, the example is Chinese Helmsley Iron is planning to develop a new iron mine in Tong Bay. And the company made a research and found the place. And the company estimates the first initial investment at $30 billion. Okay, it's a gigantic mine, plenty of iron, wonderful idea. The mine is expected to produce a cash inflow or revenue, we call it differently, but it's money that comes to the company, 10 billion every year. How nice it is. The initial investment 30, then it comes 10 billions per year, right? And then the mine is expected to work for 9 years. Okay, so the investment 30, and then it gives 10 billion to us every year for 9 years. And in the year 10, during the year 10, the company will have to do some cleaning. You know, we have to be environmentally friendly. The environment has to be really taken care of. So the company needs to do cleaning, and the cleaning is quite substantive because it will cost a hefty sum of $65 billion. So could you please draw a table with the numbers? You know, year, the flow, how it goes. Maybe I will give you like half a minute. Would you do it? Please? Because this is like we do this, these projects, and we prepare us for IRR. Okay, so 5, 4, 3, 1, 0. A table inevitably looks like that, right? We have in the year 1 minus 30, then 1, 2, 3 until 9, 10, 10, 10, and at the end minus 65. Brilliant. What a nice project, at least it looks. Then what we do, we take the following step. It's sort of a hint here, but maybe you will try to calculate at least some effort. You have all these equipments there, maybe you do. So now we try to calculate the NPV of this project, and our rate that we introduce for this would be 19.54%. I know the figure is sort of not round, but it's on purpose. Yeah, we have this formula. Yeah, we calculate this NPV, and it's important to see that we discount this minus 30, then we discount 10, 10, 10, 10 to the 9th, and then we discount minus 65 by this factor to the 10th. Okay? So what would be the number? I know I give you a bit short time. Normally we would do it really step by step. But now, because we want to avoid this hole in the lecture, pre-recorded lecture, so please, I will give you still, 10 seconds. 5, 4, 3, 2, 1, 0. And what happens? This is very interesting because we have calculated, I calculated this before. The net present value of this project for the rate 19.54% is 0. Actually, this is 0. So, who knows already what is 19.54%? Yes, I'm listening. I'm listening for the answer. I'm listening for the answer. Somebody told it's IRR. Somebody? Okay. Let's continue with the lecture. And now we have another example. We have the same project with the same table, but this time we calculate the same project at the rate of 3.5%. I mean, just to look at, to see it, a very nice 3.50, yeah, percent. So please calculate now net present value of our project at the rate which is 3.5%. The same concept as, oh sorry, there is a slight mistake. You know, it's minus 30 at the beginning. In editing, minus went out, so it's minus, obviously. The first one is minus. Sorry for that. So I hope to remember to improve this on the PDF. So it's minus, and then we go all along with this minus at the end to the 10th. And how much is this NPV at this rate? 3.5. Who calculated? Maybe this one would be a bit faster. I mean, when you use Excel, it's probably the fastest. But we calculate this. And we come to the conclusion that net present value of this particular project, please bear in mind it should be minus 30 at the beginning, is 3.50%. Is 0, yeah? The net present value of this at the rate 3.5 is 0. Ah, so hold on a second. He would say, yeah, but you told us, let's go back, you told us that net present value of the project at the rate 19.54 is 0. And now you tells us that the same project at the rate 3.5 is as well 0. So which one is the internal rate of return? Say we had in mind, I don't know, 10%. So at 19 is brilliant project. We accept it, fantastic. But if it's 3.5, it's a very bad project. So we do not accept it. But we have NPV is 0 at both. So what happens? What's going on? What's going on? Why is it all wrong? I mean, it's not all wrong. It's correct, actually, because this is this pitfall that we now describing of multiple internal rate of return. There are two of them. NPV of the project of IRR 3.5 is 0 and 19.54 is 0. And you might ask, how at all is that possible? Because we had this fantastic formula, this magic tool, internal rate of return, brilliant, so clean, so clear, that we could say so many percents and it's better than our target, and suddenly we don't know it's better or worse. It's even more complicated. It's at the same time better and worse. So what are we doing wrong? Okay, so maybe the graph will sort of helps us in this understanding. Yeah, we have this graph of this internal rate of return, and if we do it for every single rate, then we could find that NPV like nicely grows up and then goes down. And then the internal rate of return are two of them. So why is that? How could we interpret this problem? Okay, now we have the answer. Now we have the answer. The multiple rate of return appears when there is a multiple, at least double, so more than one, change in the sign of the cash flow stream. Really? Let's go up. When we had this table, somewhere. Where is the table? In fact, between period 0 and period 1, there is one change from minus to plus, from negative to positive cash flow. And then, at the end, after the year 9 to year 10, we have another change from positive to negative, from plus 10 to minus 65. So there are two. So when we have more than one, actually two changes, then we have the result that we have a multiple internal rate of return. Do you think it happens often in the real life? Are there any nice examples? Because we just had this iron mine, so which industries might have this problem? Fine. So generally this problem touches the industries with a very long time of investment, and then of a periodical need of the refurbishment, reconstruction, and cleaning, when suddenly the flow will go down on the opposite side and giving the minus figure. Like in mining, Phillips Petroleum estimated that it would need to spend about 1 billion to remove the Norwegian offshore platforms. Yeah, they pumped oil for many, many years, but at the end, they have to clean it up, and it costs a lot of money. And as well, you have a nuclear power plant, which is wonderful, fantastic, great, but then it may cost about 300 million to decommission a nuclear power plant. What I mean to deconstruct it and stop usage. So yeah, you produce a lot of money during many, many, many years, even decades, and all of a sudden at the end, you have to pay a lot. So, and there are obviously some industries that have a very obvious changes in the sign, like shipping, for example. Shipping, we have the ship. You go with the ship, you put your cargo in the wonderful, colorful port of Tallinn, and you go with the cargo to a European port of Hamburg or European port of Rotterdam, and it goes this way, and it's very profitable. Yeah, but unfortunately, once in a while, this ship needs to be repaired. This ship needs to go to a dock in the port, and then it should be refit, yeah? And again, this is the warning bell, you, in travel and tourism, hospitality, hotels. There's another classic example of this, because you build a hotel, you operate the hotel for many years, really many years, minor repairs, but after a certain period, the whole hotel, serious one, needs to be totally refurbished, totally new, and stopped in operation for a certain period, a year maybe, and then during this year, you have no money at all as an influx, but you spend money. So suddenly, in this project, you go down to minus. I warn you, you are in travel and tourism industry. And obviously mining. Mining is the classic situation when you construct a mine, coal mine, iron mine, copper mine, and then you dig, but then you have to, at the end, clean it up. we had these problems with IRR. I have already amended this for the minus, so it's okay. It will be on PDF. And we have talked about this problem with multiple rates of return, specifically for your tourism industry, for hotels. It's very important. So now again, please have a look on that, because even sometimes a very simple project, even with 2 periods, could give us this terrible headache, because like here, we invest 8,000, then we receive in the next year 50,000, and then we spend again in 2 years, in year 2, 50,000, and there are 2 answers. It could be 25% or 400%. And could you calculate this? Would you be able to calculate the internal rate of return on this example? I mean, in this lecture, it's quite easy to calculate this example 1a. And the answer is not on slides. You will have a moment, I will give you a moment to calculate. It's sort of a tricky question, but really the answer is so fast you could not believe, because this is the answer. Yeah, this is the illustration of this particular example. It has 2 internal rate of return, 25 or 400. So now, what's the explanation? The thing is, there are normal and non-normal cash flow patterns. Generally, the projects would have the normal cash flow patterns, which I give a couple of examples. It's like something with minus, like investment in the first year, zero year, and then you have like plus, like you have later profits. It's in manufacturing the most typical example. Or you have like minus, and then plus, because it's like a longer period of investment, and then later you have profits. Or other way around, it could be like plus, minus, or plus, something that firstly you have revenue and then later you have this sort of cleanup cost, right? So these are normal cash flow patterns. But to put this definition, the normal patterns have 1 change in sign. During our time of investment, only once it changes. So 1 change in sign, and then it's possible to calculate a sort of meaningful internal rate of return. But if there are more than 1 change in sign, there are non-normal patterns, because these non-normal patterns have more than 1 change in sign, and this results in multiple IRR, right? And then this is the quote: when you evaluate the project, always look at the projected cash flows and count the number of times that the sign changes. If the sign changes more than once, don't even calculate IRR, because it is at best useless and at worst misleading. This is the quote from another book by Brigham and Earhart. So always look on these sort of changes. Once 1 change of a sign, okay, we could calculate internal rate of return. If it's more than 1, then as it's written here, useless and misleading.